Hey everyone, are you considering taking out a loan but feeling overwhelmed by all the options? Don't worry, you're not alone. Today, we're going to break down the different types of loans, how interest rates work, and tips to choose the best loan for your needs. By the end of this video, you'll feel much more confident in making the right financial decision. So grab a cup of coffee, sit back, and let's dive in. Segment 1, Types of Loans. Let's start with the basics. The different types of loans available. Personal loans. Personal loans are typically unsecured loans, meaning you don't need to put up any collateral. They're great for consolidating debt or covering unexpected expenses. For example, if you have credit card debt totaling $5,000, you could take out a personal loan with a lower interest rate to pay that off. This could save you hundreds in interest. Example, let's say your credit card has an interest rate of 20%. If you only make the minimum payments, you could end up paying nearly $10,000 over time just to clear that $5,000 balance. But with a personal loan at 10%, you might pay only about $1,000 in interest over the life of the loan. That's a significant difference to home loans. Next up, we have home loans, also known as mortgages. If you're looking to buy a house, you'll likely need one of these. There are several types, like fixed-rate mortgages, where your interest rate stays the same throughout the loan term, or adjustable-rate mortgages, where your rate can change over time. Example, a fixed-rate mortgage is great if you plan to stay in your home long-term, providing stability in your monthly payments. For instance, if you borrow $300,000 at a fixed rate of 3.5% for 30 years, your monthly payment will be around $1,350. If rates rise in the future, you'll be thankful you locked in that lower rate 3 student loans. Finally, let's talk about student loans. These can help you pay for college or vocational training. Federal student loans often have lower interest rates compared to private loans, plus more flexible repayment options. Example, if you take out a federal loan of $20,000 at a 4% interest rate, you'll pay approximately $5,000 in interest over 10 years. Compare that to a private loan with a 10% interest rate, which could cost you over $13,000 in interest over the same period. That's a substantial amount of money. Segment 2, Understanding Interest Rates. Now that we've covered the types of loans, let's get into the nitty-gritty of interest rates. What are interest rates? Simply put, an interest rate is the cost of borrowing money. It's expressed as a percentage of the loan amount. For example, if you take out a $10,000 personal loan with a 5% interest rate, you'll pay $500 in interest over 1 year. That's why it's crucial to understand how interest rates can impact your total repayment amount. Fixed versus variable rates. You'll often hear terms like fixed and variable rates. A fixed rate stays the same throughout the life of the loan, while a variable rate can change based on market conditions. Choosing a fixed rate offers predictability, which can be very comforting, especially when budgeting. The impact of interest rates on loans. It's essential to know that even a small difference in interest rates can lead to significant savings over time. For example, consider 2 loans of $20,000 with interest rates of 5% and 7%. Over a 5-year term, you'd pay about $20,600 in interest with the 5% loan, but nearly $3,800 with the 7% loan. That's a $200 difference. Segment 3, Tips for Choosing the Best Loan. Now, let's get to the tips that can help you make the best decision when it comes to loans. Know your credit score. Your credit score plays a significant role in the interest rate you'll be offered. A higher credit score typically means lower interest rates. Check your credit score for free and work on improving it if necessary. Example, for instance, if you improve your score from 650 to 700, you might save $50 a month on your loan payments. Over a year, that's a whopping $600 saved just by boosting your credit score. Compare lenders. Don't settle for the first loan offer you receive. Shop around and compare rates from different lenders. Websites like Bankrate or Credible can help you find the best rates. Even a 1% difference can save you thousands over the life of a loan. Example, let's say you're looking at a $30,000 car loan. If one lender offers you 4% and another offers 5% over 5 years, you could save over $600 in interest just by choosing the lower rate. understand the total cost. When evaluating loans, look beyond the monthly payment. Calculate the total cost of the loan, including interest and fees. For example, if a loan has a lower monthly payment but high fees, it might not be the better choice. Example: if a personal loan has a lower interest rate but comes with a $500 origination fee, you need to factor that into your total cost. Sometimes that great deal isn't so great after all. Consider loan terms. The length of the loan term affects your monthly payments and total interest paid. Shorter terms usually mean higher monthly payments but less interest overall. If you choose a 15-year mortgage instead of a 30-year mortgage, you could save tens of thousands in interest. On a $250,000 mortgage, going from 30 to 15 years at a 4% rate could save you over $80,000 in interest. Look for special programs. Many lenders offer special programs or incentives, especially for first-time homebuyers or students. Check if you qualify for any of these to save money on your loan. Some states have first-time homebuyer programs that provide down payment assistance or lower interest rates. This can significantly reduce your upfront costs. Read the fine print. Always read the terms and conditions before signing any loan agreement. It's essential to understand the loan's fees, repayment terms, and any penalties for early repayment. Some loans might have prepayment penalties, which can make paying off the loan early more expensive than you expected. Plan for future payments. Consider your financial situation over the term of the loan. If you anticipate changes in income, ensure you can still afford the payments. If you plan to start a family or switch jobs, factor in how those changes might affect your ability to pay back the loan. And that's a wrap on how to choose the right loan and understand interest rates. Remember, taking the time to research and understand your options can save you a lot of money in the long run. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and don't forget to hit that bell icon so you never miss an update. If you have any questions or topics you'd like me to cover, drop them in the comments below. I'm here to help you on your financial journey. Thanks for watching, and I'll see you in the next video.